For this video, we're going to take a closer look at the different types of financial markets. We're going to differentiate primary market and secondary market, then we'd look at money markets and capital markets, and lastly, we'd get to know derivative markets, exchanges, and OTC markets. So, buckle up and here we go. Primary market versus secondary market. A primary market is a financial market where securities are initially issued. Another definition is, a primary market is a financial market in which new shares of security are sold to initial buyers. Key term, initial. In other words, a primary market is where new funds are raised. This is where it all begins. Take for example, when a private corporation decides to go public, meaning it has decided to sell its shares to the public for the first time, it undergoes what is called an IPO, or an initial public offering. The IPO is quite a complicated and highly technical process, but we should know that this is normally done through the help of what we call as underwriters, usually through investment banks, who detail the original selling price of the shares. During the IPO period, the issuing company is the only seller, and thus, when investors purchase shares through an IPO, they actually purchase shares directly from the issuing company, and the funds raised form part of the issuing company's capital or equity. Now, take note, the one who sells financial instruments, either debt or equity instruments, is called an issuer. That is why in finance we say we issue stocks or we issue bonds. A secondary market, on the other hand, is a financial market in which securities that have previously been issued can be resold. Take note, no new funds are raised. The secondary market is just a place where reselling of previously issued securities happen. In other words, this is a place where the investors trade with fellow investors. The seller is not an issuer but a fellow investor. The funds do not go to the equity of the issuing company. Rather, it goes to fellow investors. Have you heard about the stock exchange? It's a vibrant cacophony of investors buying and selling, ergo trading, with fellow investors. That's an example of a secondary market. Now, which securities normally have secondary markets? The answer to that is liquid securities. Whether debt or equity securities, only those which are liquid are expected to have secondary markets. And how do we know if they're liquid? Well, in accounting, we say they are liquid if they are readily convertible to cash with no material effect to its value. In finance, we say when they can be sold quickly for a fair price. Secondary markets, therefore, give us information on the liquidity of the securities and also provides us with intel on the pricing of the said securities. Now let's talk about money market versus capital market. A money market is a financial market where money market securities are traded. So therefore, the more interesting question is, what are money market securities? Well, these are short-term debt securities. It means that they have a maturity of 1 year or less, giving them a generally high level of liquidity. Examples of these securities are treasury bills, commercial papers, and negotiable certificates of deposit. A capital market is a financial market where capital market securities are traded. And what are capital market securities? Capital market securities are long-term and are either debt or equity securities. They are called such because they usually raise funds for the purchase of capital assets such as building and major equipment. Capital market securities typically include bonds, shares of stock, and mortgages. Since we have already talked about stocks and bonds in our previous video, let's just talk about mortgages. Mortgages are long-term debts created to finance the purchase of real estate. Depending on the nature of the real estate purchased, mortgages can either be residential mortgages for real estate purchased by individuals or households, or commercial mortgages for purchase of commercial property, or those for business use. Perhaps you have also heard about subprime mortgages. These are mortgages offered to borrowers who have been assessed to have no sufficient income or cannot make a down payment. Needless to say, subprime mortgages exhibit a higher risk of default. Lastly, let's talk about derivative market, exchange, and OTC market. A derivative security market is a financial market where derivative securities, or simply derivatives, are traded. A derivative is a financial instrument whose value is derived from or is dependent on the value of another financial instrument. A common example of a derivative security is a convertible bond, or a bond which can be converted into shares at the option of the bondholder. This means that the value of the bond will depend on the value of the shares. It sounds so mysterious right now, but don't worry, you will have more of these derivative securities in a higher accounting subject. Let's now talk about the concept of exchanges. In finance, exchanges are secondary markets in which buyers and sellers, including their agents and brokers of securities, meet in one central location to conduct trades. What you need to keep in mind is that exchanges are an organized market to trade particular financial exchange. That is why we have what we call a stock exchange. It is an organized market governed by regulations that facilitate the trading of stocks. In contrast, let us now talk about OTC market, or over-the-counter market. An OTC market, or over-the-counter market, is a decentralized market in which market participants trade stocks, commodities, currencies, or other instruments directly between two parties and without a central exchange or broker. In other words, unlike exchanges, OTCs are not organized and are therefore less regulated. An example of an OTC market is the foreign exchange market. Despite the presence of the word exchange, a forex, sometimes currency market, is an over-the-counter global marketplace that determines the exchange rate for currencies around the world. Unlike the stock exchange, there is no centralized location or marketplace for the forex market, even when it's considered the largest and most liquid, because it already deals with cash in the first place, financial market. Imagine if you would like to travel to Japan. You therefore need to convert your Philippine peso to Japanese yen, so you can go to either the bank or the money changer. This is already participating in the forex market. This transaction is called a spot FX transaction because there was an immediate exchange of currencies at the current exchange rate. A more leveled up transaction is called a forward forex transaction, as it involves the exchange of currencies at a specified date in the future and at a specified exchange rate. Because financial markets are very important to the economy, there are numerous regulations and regulatory agencies intended to regulate it, of course. And that's a wrap. See you in our next video.